you're seeing here, I think, is the classic case of the market needing a rest. Came into this year pretty elevated, rallied a bit from there to new highs. And in the last month, most of February, I was saying, it looks like there's some work to be done before we move higher, and that's exactly what I think we've seen. We had basically a 6% correction in the S&P, NASDAQ probably close to a 10% correction. The Russell, which has lagged, got hit pretty hard, but it's fine too. The Dow got hit some. They all came down to levels I kind of expected. The SP went a little farther than I expected, but like I said, down to the 200-day. It looks to me like it's basically we're about to begin the final leg of this 43-year secular bull market. Started in August of 1982. Dow back then was, I think, 780 at the bottom. So, the Dow yesterday got down to 42,400. It shows you how far we've come. And I think this last leg is going to be steeper than any of them we've seen so far. You tend to steepen as you move into a top. This is a huge top. Again, I've been at this for 51 years. I'm talking about a top of a market that for most of that 51 years, 42, 43 of them has been a secular bull market. That's about to end. That's a huge deal, and I don't think people are really recognizing that. And, of course, lots of people are trying to call a top here. They fought this market from October of 2022 on up and kind of capitulated, finally jumped in on the bull side in the last, 4, 5, 6 months, and then all of a sudden saw this thing start to roll over and got nervous again. It's amazing. I saw a sentiment indicator this morning that shows we're basically at the highs of bearish sentiment that we've been at over many years. So back to the levels of October 2022 or October 23, even back to the 2020 levels. To have a 6% correction in the S&P that gets people that nervous and that bearish is a huge statement, and it really supports my view that we're about to move into what I call a parabolic final stage. And that means you can cover an amazing amount of ground in just a few months. So from here, the S&P, my target is 7,500. That's 30% from here. The Dow, same thing, 55,000, about 30% up. The NASDAQ, 40%. My target there is 25,000. And my target on the Russell, which is the laggard, I think we're about to see that gain more speed, and you could see as much as a 60% appreciation. My target is 3,300, and that's basically 60% from yesterday's lows. So amazing kind of performance if we see anything like that. And I say it could happen in a few months. It might stretch out to 4, 5, or 6. I don't have any magic crystal ball that can tell me that. Even if it happened in 6 months, that'd be a huge run up. I actually think it'll happen faster than that, but I'm just caution people, don't get caught in thinking there has to be a precise date. This thing will go as long as it goes. The thing that will drive that, again, people underestimate what this means. We are looking at an economy that's slowing, and with, as you mentioned, the tariffs was a big issue yesterday. People were getting scared that this is the 1930s again, where, we got into a trade war with the world, and it ended up in a depression. We're not going to see a depression, but I think we are going to see the tariffs have some slowing effect. Certainly DOGE, which is, going after government efficiency, lots of layoffs there. We're going to see all those things impact. And I think the economy is slowing. If it's not in recession now, it very well could be in recession sometime in the second quarter. So we're that close to, I think, a negative GDP. The Fed's, amazingly, their last meeting basically gave the impression if we're going to have any cuts this year, it might be one. And the street bought that. So you had people talking 0 or 1, and the traders had it down to, I think, 1 cut for this year. We're back up to 3 cuts. I think, the numbers are starting to come in surprisingly weak, so it's getting adjusted. I think you're going to see 3 and probably more cuts than that this year, as not even the interest rate cuts from the Fed that matter. That's going to drive the bond market lower. You're going to see much lower rates. I've said before, I think you could see a 2.5% 10-year within the next, 6 months or less. And the Fed's going to have to start doing some QE once they recognize how weak things are. They don't recognize it yet. They're still talking about everything being pretty solid. That could change in a hurry, and I think might see it in the March meeting that they finally say we got to stop QT. And that is what will drive the small cap stocks once they and drive the market. Once investors start saying, the Fed is really easing and that we're in a new easing cycle, or that the easing cycle is going to continue and really ease with money, not just lower rates, that allows Wall Street both buy and sell side, to start raising numbers for next year. I just saw Goldman's strategist on, and he was talking about he's lowered his earnings numbers for this year from 11% increase to 9%, and that probably makes sense. The economy's slowing. He's saying next year it's 7%. What this will, if I'm right about the Fed ease, what that will allow the Wall Street to do is start increasing numbers. You'll see them go not from 7 to 9, but 7 to 15 or 7 to 20, because if they really believe the Fed's in gear and you're going to see a big easing cycle, you'll see numbers move up. And that's what will drive the stock market. But it will also do things to other assets that are bullish. I'm still calling for a global bust, which I think is bigger than 2008-9, at least financially. You'll see some ease. Not nearly the big ease will come in response to the bust, not before it. But I'm just saying that the Fed will start moving more aggressively to the easing side, both on rates and probably a little bit on QE. They have been Powell's been very outspoken about not wanting to go back to, big money printing, what we saw last cycle. So I don't expect them to move quickly in that way, but I'm just saying if the street gets to the point of saying, hey, we've got the wind at our back again, that's what's going to drive this last leg. Ultimately, I think the economy moves into recession, and like I said, could even be entering one now. Stocks can rally in a recession as long as the street believes that the recession's controlled and, mild. Where you're going to run into the problems after the top is when the reality sets in that the Fed's been too tight for too long. They waited too long to ease. They're still reluctant to ease in terms of money. The government's downsizing is having an impact. Tariffs are having an impact. And they ultimately wake up and see that the economy is not only a mild recession, it's going to be a much deeper recession, and move from there into a financial crisis, which causes a bust. But for the next, between now and summer, I think any weakness is going to be viewed as positive because it means the Fed could be on board. Last week and earlier this week, we had silver down. But I want to remind people, because there's a lot of people who say silver's done nothing. Silver was at its bottom in 2020 was 12. In 2022, it got up to 18. It's now on its way to, I think, 36. And then from there, I'm calling for 75. And these are all numbers for this year. I'm not saying it's, 2 years from now. Silver's okay. It's lagged gold. It has been a little frustrating of late because it came into this year. Basically, it's been flat this year, and the miners have been big laggards. So that frustrates investors, but I really think we are seeing the turnaround in both the metals and the miners. And by the way, gold has done obviously much better than that. Gold's at all-time highs or very near all-time highs. I have a target there of 3,400 this year, and I wouldn't be surprised if I have to raise that somewhere down the road. I'm very bullish. Probably my convictions are very high on the stock market having a final big run, as well as the metals having a big run here. The only asset that I think really will hold up in the bust are treasuries. And treasuries of all maturities, both T-bills as well as long bond and everything in between. And that's because you have a government guarantee there and a guarantee from a government that people trust. So around the world, investors will flock to U.S. treasuries because they don't know where else to go in terms of safety. I expect the bond market to continue to rally while stocks are rolling over, while metals are rolling over, most commodities are rolling over. That you could see a 0% 10-year rate at the bottom of the bust or at the top of the bond market. And that could be late this year or, first half of next year sometime. 0% 10-year. We got to 0.4, I think, in 2020, during the pandemic. This would be a new high in bonds or a new low in rates. Short rates probably go negative. And the reason for all that is because of, they're going to be slow to catch on and slow to want to do it because they're not going to want to do what they did last time. They're trying not to repeat the same mistake. But when you're faced with a crisis that's free-falling financial system, you all of a sudden have to abandon whatever you think you should do, and they will be pouring money in at a rate we've never seen before. We could see Fed balance sheet increase by 20 trillion. The Fed balance sheet got to 9 trillion in early last year and has shrunk down to maybe 7 now. When we went into the 2008-9 decline, the Fed balance sheet was $875 billion. I'm saying in this reaction to a bust, we could see 30 trillion in the balance sheet. And every central bank around the world doing something similar, just because they don't have any other tool to deal with something that's basically free falling, not just markets free falling, actual banking system free falling. And I could be wrong on that, but that's where I think we're headed. If we get something less than that, it's still going to be bad. I've been saying this for a while, as you know, that the end of this would end that way. In terms of the precious metals, they'll get hit hard, but not as hard as equities. Probably silver could get hit very hard. If we go to 75 on silver this year, it could easily come back to where we are now or lower. If gold goes to 3,400, it could come back to the breakout at 2,100. I wouldn't expect much below that. So, you do the numbers and, they're not as big as the equity markets, but still big. Still don't want to suffer something like that. The difference between precious metals and equities is that post-bust, we'll have a cyclical bull market in equities, but they won't come close to the highs of this cycle. So, it's 7,500 on the S&P. Even if you go down 80% from 7,500, you're at 1,500. Even if you go up fourfold in a cyclical bull market, that only takes you back to 6,000. So you'll fall far short of the highs, the secular peak highs of this year. Silver's, I have a number at early next decade of 500, and gold maybe 20,000. So the next cycle is going to be very much a precious metal cycle, a commodity cycle. All the commodities will go through the roof simply because all that money printing, if they do indeed print 20 trillion, that will, with a couple-year lag, start an inflation cycle that's bigger than anything we've ever seen here. We got 21% T-bills and 21% inflation back in the early 80s. I think we could see that surpassed easily in the early 2030s. So, that's a very extreme forecast. But, we're nearing the end of a super cycle that's been in existence since the Great Depression. And that's what happens at the end of super cycles, is everything goes to extremes. I think that's where we're headed.